And the one thing I've learned over the years is that the markets are not a static thing. They're always in flux. Volatility is elastic. It's always in flux. And our job as traders is not to necessarily say, hey, I'm only going to trade this one market per se. It's to adapt to the market and trade that.
Today I'm sitting down with Chris Capre. We talked a while ago. I think it's been like 2-3 years or more. So looking forward to come back to you and ask you a few questions, kind of talk about different things that happened since then. So how are you doing, Chris?
Very good. And yourself?
Very good. So tell me about overall what happened in the last like 2-3 years. We didn't really connect that much, but what's been going on for you in terms of trading or anything around it?
Yeah, good memory. I think we did it in 2018, probably around springtime that year. So, in 2018, I was in Lake Tahoe at that time. I'm still in Lake Tahoe area. So since then, I've kind of had a major shift in my trading. I started off trading FX back in 2000, 2001, and that was my primary asset class. And over the years, I started to expand asset classes because it's my belief as a trader that there are kind of 4 stages of professional trader development. And the first is just getting stability, consistency in your performance. And that's stage 1. And then stage 2 as a trader is once you start gaining stability and consistency in your performance, then your job is to start increasing position sizing. So that's what we call vertical laddering, where you're trading the same as you are before, but then you slowly increase position size so that you can make more money for the same amount of effort. Then after you've been able to do that and scale up, then you start wanting to move into what I would call horizontal kind of laddering, which is basically where you start to expand asset classes. And so I started to do that way back in early 2011, 2012, 2013. And I started to do it really hardcore when I was in Canada in 2014, 2015. And it really kind of expanded the different markets that I could make money in. And after I'd been doing that for about 5 years, so from like 2014 to 2019. And then I moved home, we did our interview in 2018. And so I had already been home for a couple of years, but the Forex market, as we've all seen, volatility has been collapsing. If you look at the average true range of the euro dollar or pound dollar over the last 5, 6, 7 years, you just see a line that's just steadily declining, on a weekly basis. The weekly pip range is just declining. What's that a function of? It's very straightforward. It's a function of central banks pushing interest rates close to zero across the board. You can't get any yield. And if there's no yield, then there's less institutional interest to put their capital into a particular currency because you're not generating yield every day. So as yields have kind of compressed down to zero across the board, and there's not much yield differential between currencies, you've seen reduced flows into FX, and that's created reduced volatility. And less volatility means less possibilities to make money, less directional moves, less directional strength. And so, I felt like, okay, I need to make some changes here because it's not what it used to be. It's not the market that I had started way back, 15, 20 years ago. And I felt like, okay, let's start diving into stocks a little bit deeper. And when I got into stocks, I realized that there were certain tools that I had always wanted in FX, but that weren't available, such as legitimate level 2. Such as time in sales, not just like the broker time in sales, but actual time in sales, such as open interest, such as dark pool flows. There's all this information. There's volume, VWAP. All these tools were really giving an insight into the order flows into the market. And we all know that order flow is the most proximate driver of price action. And so having all these new tools to see into the order flow into the market, it changed my perspective. I'm like, oh my God, I'd wanted this in FX for years. You just couldn't get it. But then on top of it, if you think about it, your FX broker probably has maybe 100 FX pairs to trade in total. But in reality, some of those exotics, you're never going to trade. You're probably not going to trade dollar Thai baht on a regular basis. You're probably not going to trade dollar Turkish lira on a regular basis. So the majority of those currencies, you can't really trade. And really when it comes down to it, you have about maybe 40, 50 currencies to trade. So on any given day, I only have 40 to 50 currencies that I can trade. And volatility in FX pairs is maybe 1, 2, 3% on a really good day. Well, in stocks, you have 30,000 in the US. And if you look at some of the moves today, so one of the stocks I was trading, NMRD, moved over 100%. You have probably 12 to 30 stocks that were moving well into the 20, 30, 40% ranges for the day. So you have more instruments and you have more volatility. And it just made me realize, I'm like, oh my God, this is like, I feel like a kid in a candy store. And so I just started to go hardcore into stocks, and I just started killing it right off the bat, because the volatility is such a useful thing to have, and have so many instruments that you can trade from. Super, super helpful. And so that was kind of like one of the biggest changes that we've made in the last few years since we did our interview.
Do you trade stock in the same way where you trade Forex, the same kind of setups or patterns, or is it a different thing completely?
Yeah, great question. So my whole style of trading is based upon, a very simple premise that order flow is the most proximate driver of price action. So all the prices that you see moving in the charts, that is predominantly derived by order flow. And so it doesn't matter whether you are a technical or a fundamental or sentiment or flow-based trader, eventually you have to make a buying and selling decision. If you don't make a buying and selling decision, your flows don't affect the markets. If you make a buying and selling decision, that becomes actualized order flow. And so when that order becomes it doesn't matter where that information comes from, it all has to go through this narrow corridor of order flow. It all has to eventually become an actualized order flow. And once that happens, it becomes part of that pool. And that collective pool is what determines the movements of the markets. So our price action methods have always been about understanding what's going on in the order flow in the markets. And so they're not based upon candlestick patterns or anything like that. They're based on common order flow patterns. And so because of that, the same patterns that work in FX also work in stocks. They work in crypto. They work in commodities. They work in all markets, because those patterns of order flow create very specific structures and very specific movements.
Do you think that you would have gone to start to trade stocks if you were in a different time zone, or like let's say in Asia or in Europe? Would you go to stocks, or would you stick to Forex basically?
If I moved, I would still trade. I still trade FX. I trade stocks, FX, options, commodities, crypto, global indices, bonds. I trade it all. If I went to, say, like in your time zone, Asia, I would probably trade the ASX, which is a pretty darn good stock index. There's good volatility, good flows in it. You have a fair amount of stocks. I would consider some of the Japanese stocks, maybe the Hang Seng. I want things that have good movement and volatility. And so, yeah, I would probably trade those, maybe even something on the Taiwan exchange. There's a lot of good Asian exchanges out there, so I still would trade stocks. But whichever one I did, I would also want the capacity to trade options. So options has become a big part of my trading. But yeah, if I was in Asia or Europe, I would trade the major stock markets at that time.
How was your learning curve? Because options are completely different from stocks or Forex when you trade them. So how was your learning curve to go to options? Was it something easy, that you read a book and you were able to understand it? And I want to know how easy and how did you learn exactly?
Options is probably one of the toughest learning curves in trading. The reason being is partially because of the technical language, but also because if you think about it, when you buy a stock or an FX pair or whatever you buy, crypto, if you buy it, you want it to go up. And if it goes up, you make money. If it goes down, you lose money. It's very straightforward. If you sell a crypto pair or something like that, you want it to go down. If it goes down, you make money. If it goes up, you lose money. So it's very two-dimensional. It either makes money or lose money, and it goes up or down. That's it. That's the only way you really make money. When you start trading options, you can make money if the stock goes up, down, or sideways. You can't do that in crypto. If the crypto price goes absolutely nowhere, you make no money. So maybe you can get an interest-bearing account, but that interest is you're not going to retire off that interest. People's interest or capital gains or dividends and things like that. Nobody ever retires just off their dividend. It's the capital appreciation in the portfolio that allows those dividends to actually become a decent side income. But bottom line is you make nothing if the market goes nowhere. Well, with options, you can make money if the market goes nowhere. On top of it, imagine if you buy a stock or a crypto and it goes against you. You buy it and it starts to go down. Well, that position is going to lose money, but with options, you can actually make money on that going down. So you can actually hedge your position. And so options gives you more complex ways to make money. You can make money based on time alone. So the passage of time can help you make money on your option, and volatility can help you make money on your option. You can get long what is called volatility in options. So if you think that the market's going to break out and it's been kind of consolidating for a little bit and it's about to break out, you can make money on that. You can bet volatility is going to increase and make money just on the increase in volatility. You can also make money on a decrease in volatility. So maybe there's been a big trend and then all of a sudden the market starts consolidating. Well, you can make money on that volatility decreasing. So the options learning curve, way harder than buying and selling crypto, buying and selling Forex, buying and selling stocks. It's totally different. And so the learning curve is much steeper, but once you really get into it and you start to understand it, it totally changes the way you look at markets. You will never look at markets the same.
How do you learn options? Was it by talking to the traders who are doing it, or by kind of searching info on your own and trying to do it?
Yeah. So I started off with just books and videos. And as I started, it took me probably a good 2 to 3 books and probably about 5 to 10 videos before I even started to feel like, okay, I'm finally getting the basics down. And so it was definitely a steeper learning curve. And so in a year, I probably digested about 50 options books and probably went through 200-300 option videos. But then as I started to go through the options trading world, I've started to discover that you have certain types of players that are operating on various levels of skill and intelligence about the option world. So for example, there's some people who literally, they just trade the option strategies. And one thing that's unique about options, the options market, is all the strategies are known. All the strategies are out there. There's no like hidden strategies per se. The same strategies that you can trade, I can trade, and everybody can find out about them. So the strategies is not really the difficult part. It's understanding how to leverage and use those strategies. So I started to learn that there's some people that just focus on like trading the option strategies. But then as you start to go a little bit deeper, people start to manipulate the pricing mechanisms within options. So you have volatility, you have time, you have the rate of change of volatility that affects pricing. You have all these things that start to affect pricing. And the more subtle you get into options, the more you can start to manipulate those prices to your advantage. You start finding dislocations in prices. And so think of it like this. You ever traveled to California before?
No, never.
Never been. Okay. So I've lived in California for a long time. As you hear a lot about, I'm sure you've heard about fires in California before, like some big fires, right? So in California, you have to have fire insurance in most homes. And if you were to buy fire insurance right after a fire, that fire insurance is going to be expensive because the risk of another potential fire is just around the corner. And so those insurance companies are going to say, hey, your fire insurance is going to be this price. But if there hasn't been a fire in 5 years, well, then the price of that fire insurance is going to be much lower. The markets work the same way. If we've been in a bull trend for a long period of time, who's buying downside protection in a market that's consistently trending up? Very few people. So that makes that downside protection cheap. Well, if you can get really good at timing when the market is likely to move into a potential reversal, you can buy the protection before it becomes expensive. And then the first down move in the market, everybody's like, oh, shoot, we got to start protecting our downside. So then they start buying what are called put options in the market. Those same puts now jump in price because the market has sold off a little bit. Everybody's buying protection now. And so because everybody's rushing to buy it and there's more risk of a downside move, those same puts now become more expensive. So you can learn to buy them cheap right before the market starts to roll over. And then you can take advantage of that price dislocation once the market does roll over. So you can buy things cheap and take advantage of repricing of risk. And so that is, one of the unique ways that you can start to use options. It's definitely more complex, but if you have a fair amount of experience and timing and skill and understanding how markets work, then you can use that to your advantage.
Interesting. Now, tell me, how do you manage trading kind of three different markets? Because obviously you need to kind of decide when you want to trade which one and how to plan your day about going with each market. How do you do that?
Mostly where are the flows and where's volatility going? So, for example, when the markets sold off after COVID, we had the fastest fastest like 30% correction in history. But then the markets bottomed like third week in March. I think it was like March 21st. And when that happened, we had known for a long time, because I've been doing this for 21 years, and experience has told me that anytime you have a very big sell-off in the markets, when the markets start to recover, the overperformers, the stocks that tend to perform best in that time period, tend to be small caps. Small caps tend to rebound fastest. And so for that, usually 1 or 2 year returns in small caps, they tend to kill mid cap, large caps, value. They tend to kill everything. And we saw that, we saw that very, very clearly. Small caps were just going gangbusters, March, April, May, June. Don't get me wrong, the mid caps and the large caps, the mega caps, they were doing well. Small caps were killing it. So we directed more of our portfolio to what was moving the most. Then, the markets, if you saw the trend, started to pull back a little bit. End of February is like third week in February. S&P, Q started to roll back a little bit. So when we started to see that, we started to see differences in like, hey, small caps are now not performing. And the ones that are holding their strength is now mid and large caps. So you saw a rotation happening in real time, which is something we've known for years. Small caps kill it, but then eventually they start to fade and mid and large caps start to take over. So we tend to trade strength. We look for things that are really strong. We try and get long on those. We look for things that are really weak. We try and get short on those. Once COVID hit, we felt travel, entertainment, all those things are going to be weak. So we shorted airlines, we shorted hotels, we shorted any sort of like casinos, because you can't go to them if they're going to all be shut down. And if you look at airline industry and casinos, they all tanked the hardest and took the longest to recover. And so we look for things that are really weak, we short those. We look for things that are really strong, we get into those. And then things that are going into kind of a neutral environment, we shift gears. We don't get long or short, we trade neutral on that. We trade, we actually sell options to play that range. So for us, it's important just to understand, is it in a period of strength, weakness, or neutral? And then we adjust our strategies. Now, in terms of how I trade it and manage all these markets, right now, as we speak, I have 34 open positions. So like right now, I have 34 open positions, and that's not even, that could be like 34 stocks, but then I also have options on those stocks. So if you count all the positions I have open, I'm managing roughly 60 positions on any given day. And in terms of how I manage it, I just built up a kind of a capacity over time to hold more and more instruments. Before COVID, I was probably on average trading maybe 10 to 15 instruments. Once COVID hit, I started expanding that to like 20. And then, as 2020 went on, I got to about 25. And this year I'm now consistently managing 30 plus positions. I've had 30 open positions now for pretty much all of 21.
Pretty crazy. So how do you find which stocks or which kind of industry you want to trade? Is it some sort of scanner that you use?
Yeah, Benzinga Pro. So Benzinga Pro is, it has a lot of features in it, but it has 4 main components that I really use. And I can show, how to use it when we get to like chart time and things like that. So I'll show an example of how we used it today. Mm-hmm. But Benzinga Pro has the 4 components that I use. It has a news feed. So it's constantly giving me like live updates on stocks. Hey, option alert on this stock, earnings announcement on this stock, such and such person was talking about this stock, merger on this stock, whatever. So it's constantly giving me news, and that kind of gives me ideas throughout the day when stocks are moving slowly. But then it also has an earnings calendar. So I know what earnings are happening for today. And so earnings tend to create high volatility situations, potential trade opportunities. But then on top of it, it has this movers section. In the movers section, it has a way to filter out what is moving by volume in terms of today's volume, it's average 10-day volume. So I can see like, hey, how's today's volume in relationship to the average volume over the last 10 days? And if we have, if we're trading 50 million shares on a stock today and its average 10-day volume is 20 million shares, then it's over 150% above the average daily volume. That's a stock that's generated a lot of institutional interest on this one day. And so that allows me to zero in on that stock, start looking at the charts, start looking at the flows and be like, okay, is this a setup that I'd be interested in trading? So Benzinga Pro is really my main scanner that allows me to filter through these 30,000 stocks and just make it essentially like, hey, here's the top, 50 movers on the day. And I can just look at the numbers and be like, okay, yeah, that one, and then start to isolate from there.
I'll definitely be curious to see how you do things, like what kind of strategy you take and everything. But I was wondering, so what would be advice for someone who doesn't want to change to other markets? They want to stick to Forex for whatever reason, whether it's capital or whether it's they just started to trade Forex now and they want to master it first. What would be advice? Should they kind of change the trading in any way, or should they adapt to in some ways?
I think our job as traders is always to adapt. Did you ever read that book, Jesse Livermore's book, Reminiscence of a Stock Operator?
Yeah, great book.
It's a great book. And so, if you read, he's one of the most successful traders of all time, but he had kind of a tragic ending, and he ended up, compared to what his wealth was in his peak, he ended up relatively broke. And in his last kind of few months, there's a part of him that laments and says, I just didn't learn how to adapt to the new markets. He was kind of hoping that the markets would stay the same. And the bottom line is the markets are always in flux. I've been doing this for 21 years, and I've gone through like some sort of major crises once every 2 years. You got the flash crash, Swiss National Bank revaluation with the Euro Swiss, London terrorist bombings, 9/11. Like, it comes out to literally one event every 2 years. And the one thing I've learned over the years is that the markets are not a static thing. They're always in flux. Volatility is elastic. It's always in flux. And our job as traders is not to necessarily say, hey, I'm only going to trade this one market per se. It's to adapt to the market and trade that. Tulips would have been a great thing to trade during the tulip crisis. But then after it crashed, you really didn't want to trade tulips after that. And you could have stayed there and be like, oh, I'll just keep trading tulips. But maybe there's no more market for that back in the day. So our real job as traders is to always adapt to the markets. If somebody wants to stay with Forex and they feel like, hey, I need the leverage, I don't have the size account, it's easier for me, it's harder to trade stocks or whatever country I'm in, then my suggestion would be to try and trade a broker with as many currency pairs as possible, so you can have as many instruments as possible to trade. And I would try and find a way to trade where you can understand what's going on in the order flows in the currency markets and then trade that. If you can do that, then you can build a set of skills that will help you with Forex. But if you ever decide to go to another market, you'll have the skills to adapt to another market.
Very cool. Do you know any kind of scanners you can use for Forex in the same way as stocks? So you have a bunch of currency pairs to trade with your broker.
I'm trying to think of like who does a good scanner. Like XTB through their XStation 5 has a pretty good heat map. Mm-hmm. They have a pretty good heat map. And what it'll tell you is, and it kind of shows you in colors, basically, hey, here's the percent movers of the currencies versus the dollar. And it'll show, the ones that are like really red, those are the ones that are like most down versus the US dollar. And the ones that are really green are the ones that are like strongest versus the US dollar. So that would probably be one of your best bets, is to have some sort of heat map that shows the strength and weakness of each currency versus any particular currency. So it's not just versus the US dollar, but you can see how are all the currencies doing against the euro? How are all the currencies doing against the CAD or the yen? And you can see where volatility is on that heat map. So that would probably be the best one, but there just aren't as many scanners out there in Forex. Forex market is great for platforms. Like FX platforms are generally light years ahead of stock platforms. If somebody starts in Forex and they go to stocks, you often feel like you're working with a dinosaur of a platform. You're like, who designed this? Like, why is this like 10 years old? You know, it just looks really weird. Forex did a great job of simplifying platforms and really upgrading the technology, but they haven't adapted other areas that stocks have, like these scanners that can really filter out, you know, here's the news events on it. Here's the strongest or weakest currencies. Here's where the largest flows are going on that day. Here's where the option open interest is on those currency pairs. So they just haven't adapted in other areas. And so probably XTB's XStation 5 would be, as far as I can tell, one of the best heat maps out there.
Yeah, if you want to go ahead and show your charts and show kind of what you look for, how you scan stocks, and then what you trade, that would be really cool.
Sure. So I'll show you, let's go to our Benzinga scanner. Okay, so these are the 4 sections I was talking about. This is the news section here, which is great because if a news comes out on a particular ticker, like let's just say there's something on JP Morgan, I click that and it'll automatically change the chart in TradingView, the TradingView charts to that on a particular time frame. And I can just click on this and it'll give me kind of the news underneath, which is great. It helps me like quickly digest the news and say, hey, is this a mover or not? So here's the news section. Here's my earnings calendar, which you reset each day. This is the mover section that I was talking about. And so these are the main columns that I'm looking at. I'm looking at volume in relationship to average volume. And then I'm looking at how much of a percent gain is it on the day. So what I'm generally looking for pre-market is something that's moving 600,000 shares or more, because once you start getting to 600,000 shares, that means that there's a fair amount of eyes on that particular stock. If it only has 50,000 shares pre-market, it doesn't have enough eyes on it. It's not going to move on the day. So we look at some of these stocks here, 216 million shares. Its average volume for the last 30 days is 3.3 million. So that's almost, I don't know, what is that? Like 60, 70 times the average daily volume. That's an insane amount of institutional interest, all focused on that particular stock. So I can look at that stock and be like, okay, it's generating a lot of volume and it's up 23% on the day. That's a big mover. Like imagine if the euro dollar moved 20% in a day from like 100 to like 120, you know, that would be like, think of the profit potential you could make on that. It's huge. So here's a stock that we focused on today, which was NMRD. And what we did is we clicked on it. We saw it was moving pre-market. It traded 52 million shares and its average is 227,000. So this is a stock that normally doesn't move much at all. And then just generated a boatload of institutional interest. So we saw pre-market that it was generating interest. We saw it was moving quite a lot. And so we clicked on it and we get this news alert here. It says, Numara Medical shares are trading higher after the company receipt of a purchase of 5,000 sugar beet transmitters, and 200,000 sugar beet sensors for its UK license. So this is something for that's like diabetes, for sugar, insulin, things like that. And so they got a huge order for it. This is a legitimate positive news catalyst. This is a small stock, doesn't generate a lot of interest, and it just got a big order. Well, that's bullish for the stock. It's going to get a huge capital infusion from the sale, and it attracted a ton of interest. And so when we look at this, we can see this is a stock that normally doesn't move a whole lot, and all of a sudden it just starts ripping. So it starts around $5 in the day. It ends at $12.80. That's a lot of movement for us to take advantage of. So we zeroed in on this stock, and this is what we did. And let me show you on the charts on that one here. So NMRD. So we actually, we missed this move right here. And let me expand the 5-minute chart. We missed this breakout right here. And I could probably pull up my trusty pen so I can draw on the screen here. Give me a second. Let me load that up. Okay. So it had a good rip, $5 to $8. Then starts to consolidate back, and you start to get this curling motion, and you start to see volume building. Anytime you see an increase in volume, that means, you know, large orders are starting to come through. It's attracting a lot of interest. Breakouts are much more likely on large volume versus no volume. Like how many times have you traded a Forex breakout thinking it looks perfect, it looks great, it's going to be great, and it just doesn't go anywhere? There's no volume. We can use volume to see, hey, this is a legitimate breakout or not. So we get this legitimate breakout, but it's like during New York lunch. So I was like taking a nap at this. I missed it. All my traders started to look at this pullback and we said, hey, this is corrective. And it's going right into the 20 EMA and right towards the VWAP, which is a stock indicator. And so we felt like, hey, if this starts to bounce, we're going to get long. So clearing all this, and let's zoom in a little bit further. So some of my traders got long right around here on this break. So some of them started to buy around like $8.75, $9. And what do you see? Impulsive, corrective, impulsive, weaker pullback. This pullback goes past the 9 EMA, which is this green line. This pullback is much more sideways and just sits right on the green line. So we bought the initial breakout of this, or anticipating the breakout. It didn't break out, so we closed it after 5 minutes. Then we rebought on the breakout here, and then we closed right around here before this last pullback in the day here. Just a quick scalp, 15, 20 minutes, not even that. It was like 15 minutes, made our profit, out, done. And so that was just like a sample trade. And we wouldn't have found this unless we had the scanner. And so this was just like a simple trade that we traded on the day. Another one that we traded recently, an option play, is IWM. So IWM is the ETF for the small caps, or the Russell 2000. And so what do you see on this weekly chart? It's going nowhere, right? Going absolutely nowhere. Now, if you are a Forex trader or a stock trader, you're not going to buy or sell this because it's just going nowhere. There's no movement in the socket. Well, what we realized is that, hey, we looked at this and we looked at options positioning, and we realized there's not a whole lot of interest in small caps right now. Option open interest is down. Volumes are down, as you can see, over the last 1, 2, 3, 4, 5, 6 weeks. What do we see? We see volume decreasing, one big surge, and then volume decreasing as well. So there's reducing interest through volume. There's less option interest in the market. This is something that's going to go absolutely nowhere. So what did we do? End of, I think it was last week, we bought a 1-week option that expires this Friday. And if it stays between, I think it's like 228 or like, I don't know, 213 or something like that, we get to keep our credit. And we sold the option. So the way this works out is, if you want to get long a stock, you have to buy the stock. If you want to get long an FX pair, you have to buy the pair. What if you could be the other side of the transaction? In other words, what if instead of buy, like for example, the fire insurance that I had to buy, what if I could be the person who sells the fire insurance? So if you think about it like that, when you buy insurance for your car or your house, or whatever it is, you have to pay money to an insurance company. That is called a premium. They get to keep that premium right off the bat. So whatever you pay them for the year, the quarter, they get to keep all that money. If you don't get in a car accident on your car insurance, they get to keep all that money. With options, we sold the option that the market would not go very far, that it'd be stuck in this tight range. And if it stays in this tight range, the person who we sold the option to, we get to keep all that money. But here's the great thing about options. You get paid to get into the trade when you sell options. So think about it like this. When you buy Bitcoin, Ethereum, Eurodollar, do you get paid the moment you enter the trade? No. When you sell options, you get paid the moment you enter the trade. It's called a credit. The person who is paying for that option, that insurance contract, so to say, they have to pay that to somebody. Well, that person is me when I sell the option. If it breaks outside of this, I have to pay out of my pocket to do that. But if it doesn't break out of that range, I get to keep all that premium. So this is what we did. We sold an option that this thing's going to go nowhere, and we only have 2 more days. We have Thursday and Friday. On top of it, this is the other part I was telling you about. Remember how I said you can make money via time?
Yeah.
Okay. So this is the other part that's really interesting that people should check out when they look at options. If I have a car insurance contract for a year, let's say I have to pay, like on my BMW, I have to pay, I don't know, $4,000 a year for my car insurance. Okay. So I have to pay that for the year. I pay that out. And if I have a car accident, then I can call my insurance and they have to pay for the damages and things like that. Well, as we get further along in the year, I have less and less time to use that car insurance. And every day that I get closer to the end of that year is another day that money that I spent is likely going to be is less valuable. I paid $4,000. We're now 10 months into it. We're now 11 months into it. I have no accident. The chances that the insurance company is going to keep that go up and up and up each day. Same with options contracts. When I sell options contracts, they're worth X amount. And every single day, those contracts become less and less valuable to the person who bought them. And eventually by Friday, these contracts will be worth nothing. So each day that market goes nowhere, my option contract that I sold becomes less and less worthless to the guy I sold it to. And that means I get to keep more and more of the money each day. So every single day that this passes over that 1 week, my option contract becomes more valuable to me and less valuable to them. So we literally have Thursday and Friday at this point. If it doesn't break out of that range, I get to keep all that money they paid me. So this is an example of how we can make money if the market goes absolutely nowhere. Does that make sense?
Yeah. So how do you protect your downside risk? Because for someone who's starting out, let's say in options, I think it would be really hard to take the right place, and not taking the right place could mean that you would lose a lot on the downside.
So if you think about like when you trade, let's say you buy euro dollar. Let's say you think euro dollar is going to go up today. How can you actually hedge your position on a euro dollar?
You could short a different currency pair.
You could short a different currency pair. Is it going to be a true one-to-one hedge?
Probably not, but it's close to it.
It's close to it. Okay, now here's another interesting question. If you were to truly hedge a long euro dollar position, the only true way to do that outside of options is to also short euro dollar at the same time, assuming your broker allows both directional trades. Okay, now that by long and shorting the currency, you've actually added a whole new layer of complexity. One trade's going to be in the money, while the other trade's going to be losing money. You might be able to make money on both, but you have to time each individual leg well. So that means that like when the one leg is making money, you have to be able to like time the top of that. And then as it starts to pull back and the other short trade starts to come closer and closer towards the money, then you have to time that one as well. And if you mistime one of them, you've wasted some of your profit or you've lost money on both. And so it's not a real natural hedge. With options, you can have a natural hedge on it because I can be long euro dollar, but then I can also sell calls on the euro dollar. So in terms of how you use options to hedge your downside, so let's go to euro dollar. Euro dollar was, what was it? 119.50. Yeah. Okay. Close to the 120. Okay. So euro dollar right now is 19.95. This is a weekly chart. Let's go to like a 1 hour chart. This is a chart we were looking at earlier today. Let's say I buy it right here. Let's say I buy it at 19.95 and I have a stop loss at 1984 or something like that. Let's just say I have a stop loss further down. Let's make it like 1860. So my stop loss is down here around 1860. I have about 135 pips to the downside. Now what I can do is I'm long euro dollar right here. I want it to go up, but if euro dollar starts to go down, I can do what is called, I can sell calls. A call is an option contract that makes money if it goes up in value. Well, if euro dollar loses value, then that call loses value, but I'm the option seller. So I get a credit for getting into that trade. And if this starts to lose money, then my option, while my euro position is losing money, my option is actually making me money because the option call makes money if it goes up. But if I sell that call, I want it to go down. So the way it looks like this from a P&L perspective, let's move this white screen over. So we just have pure white screen to work with. And here's a traditional option P&L chart. So this this x-axis here is price. And what this means is if price goes up this way, that's price going up on the x-axis that way, and price going down this way. The y-axis is your P&L, and you always have a break-even line here. So anything above this, I'm in profit. Anything below this, I lose money. If I buy euro dollar and it goes down, well, then my P&L is just very straightforward. I lose money. However, let's say I buy euro dollar and the price, let's say I buy it here and the price starts to go this way, goes down. It's going down this way. Okay, technically I should start losing money in this euro position, but I can sell a call. Let's say I think euro is going to go to 120 and a half. So I can sell the 120 and a half calls up here and I can make a few $100, maybe $1,000, maybe a few $1,000 credit on that. So my euro position is losing money, but I get the credit on the calls. And so it neutralizes the risk on the euro dollar going down. So basically what happens is instead of this losing money, I get to offset it with the calls that I sell. So instead of it being like that, it's more of like that, or it's a much milder loss. So I lose less money. Instead of losing the full position on the euro dollar, I'm losing the full euro dollar position, but I'm gaining money on the option. So imagine if every single one of your losses, you could have lost less. That is a way that you can hedge. Also, another way to look at it is like this. There's my P&L line. Let's say I buy euro at let's just say 120. And I want to sell the 125 calls. Okay, the way it works is like this. I get into the position at 120. If the euro dollar goes up, I make money. As soon as we get to 125, I no longer make any more profit, even if euro dollar keeps rising, because I sold the 125 calls. After 125, 126, 127, those calls start losing me money. So I keep the initial credit, but then my profit maxes out at 125. So I have two ways to make money. I can make money if the euro goes up, plus the calls I sell, or if euro dollar goes down, I lose money on that, but I still make money on the calls. So it neutralizes my profit. Does that make sense? I mean, it's a little tricky, but
are you always having two positions when you trade options, or can you just go in one and just trade the option alone?
Great question. You can just trade the option alone if you want. Trading the option is a derivative contract, basically. It's like a CFD. Contracts for difference are derivative contracts. If you buy a CFD on the S&P 500, you actually don't own the shares on the S&P 500. You're trading a derivative on that. Options are the same way. So for every stock position I have, almost all of them, I have an option position on to neutralize some of that risk. And there are some stocks, though, that I will just trade the pure option, because then one thing about options that you get that's very much like Forex is you get much better leverage with options. Stocks, you don't get a whole lot of leverage, 2 times, 4 times leverage. With options, you can get much bigger leverage, 20 times, 50 times, close to 100 times, depending upon the pricing of the option. So yes, I do trade some options by themselves, but then, a lot of times I'm trading options with the actual stock so that they're paired together.
What would be your advice for someone who's starting out in an option? Do you have any resources for them, or would you tell them to just kind of learn on their own with books? What would be the best way to do it?
We are actually this Friday launching our first ever intro to option video on YouTube. And so we've done a few videos on options before, but we felt like, okay, we got to create a foundation. It's a whole new language. So literally this Friday we're just finalizing the edits right now, but it's like a 45-minute free intro to options course that we're launching this Friday. So that would be May 7th. It'll go live. And so that's part 1. Then we're going to create part 2. Another good resource is Option Alpha. They have a ton of free videos on their YouTube channel on all the basics of options. They are great for kind of creating like a foundation, going through all the strategies and things like that. After a certain point, as soon as your skill level gets to a certain point, you kind of get past them, but they are a great primer for new people. I also have a really good book, Darcy Malone's Intro to Options Trading. I think it's one of the best good options trading book for beginners. It does teach you all the basics. It even gives you some strategies, which is great to start off with. That's the one thing I also liked about options is that if you think about Forex, you kind of have to go to places to get strategies. With options, all the strategies are just out there. Everybody knows all the strategies because there's only so many mathematical combinations of strategies you can do. So there's no hidden strategies per se. What the real skill is in how do you leverage those strategies. So every book will teach you a lot of the same strategies. They'll all have different perspectives. Trade King also has a really good book. Trade King has a really good book on option strategies called the Option Playbook. So those would be two that I'd recommend for people that want to get started in that.
Awesome. That sounds good. We'll put the links in the description of the video and the podcast as well for people to check them out, especially your video that you're publishing this Friday. So that's cool. And so, yeah, anything you would like to mention you didn't kind of touch on or talk about yet that you would like to talk about?
I kind of want to reiterate the point that, that thing about Jesse Livermore, that he never adapted. And our job as traders is always to adapt to the market. That may or may not mean changing asset classes. But if it doesn't, if it means we're going to stay with the same asset class, then we always have to adjust to the market as is. We want to think that the markets will always be the same, and we like it to be that way. And it just doesn't work out that way. The bear trend that we had in COVID, some people thought that was going to go way further. It was going to last for years. It lasted a month. The bull trend that went from March 20 to February 21, people thought that was going to go ad infinitum. It didn't. And so it's important to understand that volatility is elastic. Markets are always changing. Our job as traders, the first job, my approach is simple. My first job in the market is to control risk. Once I can control risk, then my job is to extract alpha out of the market. And I do that by adapting to the market that's always in front of me. And if you have skills, then you will be able to adapt. A lot of people are focused on like strategies. Strategies come and go. Skills never die. If you think about it in the game of football, or what the Americans call soccer, passing, dribbling, trapping, footwork, those skills today are just as important as they were in the game 100 years ago. Leonardo Messi, like one of the best footballers of all time, one of his great strengths is that he is exceptionally good at one of the core skills, dribbling. He can dribble and have faster touches on the ball, and his body has a metabolic rate that allows him to control his energy or burst more energy in quick bursts faster than anybody. But he's just applying the core skills of soccer. And so trading is very much the same way. If you have the core skills down, you can trade any instrument, any time frame, or any environment, and you'll be able to adapt to any market in front of you and continue to pull money out of the markets. That's our job as traders.
Awesome. Thank you, Chris. I appreciate it. I know people will like your advice for sure, and that's been really insightful for me as well, and I hope the viewers will think the same. And I'll talk to you pretty soon.